Jenny Brown. Welcome to MFB News. Hope everybody is great. For those of you who are on half term with your children, I hope you are somewhere very sunny, exotic and all-inclusive. Sadly, not me. I'm here in sunny Sevenoaks, and it is sunny today, thank goodness. Yesterday was a shocker, wasn't it, on Tuesday, and the bank holiday. Not bad, pretty average though. But what do we expect? UK bank holiday weather standard. Now, in terms of what we've got for you today, we're going to go through swap rates. We're going to talk about what's been happening with inflation. I'm sure most of you would have seen the news last week, what happened there. So we're going to have a bit of a delve into it and find out what's actually going on under the bonnet. And then we're going to be talking about rental yields by region. So what's going on regionally in terms of yields you can expect on property investment. Okay, so let's touch on swap rates first of all. And well, it's not really that different to last week, actually. It was slightly higher yesterday, but it seems to have come down overnight, which is good news. Not by much, but kind of brought us back in line with last week, whereas as of yesterday, we were higher than last week. So I'm glad I'm not delivering that message to you today. So 2-year swaps are just under 3.8%. 1 month ago, they were just over 3.6%. And 1 year ago, they were just around 4.65. So actually, you know what, month on month, we are up by around 1.5% on 2-year money. Not great, but actually year on year was definitely ahead of the game. So we'll take that. In terms of your 5 years, we're just over 3.8% at the moment. 1 month ago, we were at 3.6. So again, 0.2% increase month on month. And 1 year ago, we were just over 4%. So same story there. So ahead of the game year on year, but month on month, actually slightly more expensive. So in terms of what this means for mortgage pricing, I know I sort of talk about this very, very often. Actually, lenders' cost of funds has increased by sort of, depending whether you're looking at 2 or 5 year money, between sort of 0.15 and 0.2%. So the reality is that the lenders who priced down recently when swap rates came down are now kind of probably scratching their head and thinking, this is a bit difficult because our cost of funds has increased. This is eroding into our profit margins. We're going to have to put our rates up. So actually what we haven't seen in the last week, and we'll come on to lender pricing changes in a moment, we haven't seen a massive run of lenders putting their rates up, and actually a couple of lenders have adjusted downwards. So it's all a bit kind of up in the air at the moment. But like I say, I think lenders' cost of funds fundamentally has increased. Therefore, in practice, or in theory at least rather, we should be seeing lenders' pricing go up. But let's wait and see. Now, in terms of impact on base rate going forwards, so the inflation news is kind of not been great for swap rates. Why is that? Because economists are now forecasting that there won't be a base rate cut in June, which a lot of people kind of were expecting, and any further or subsequent rate cuts this year down to 50% likelihood. So essentially what they're saying is actually inflation has become quite spiky again. Actually, this is going to kind of put more pressure on the MPC to not reduce interest rates going forwards, or reduce them much more slowly at least. Therefore, actually, base rate as an average over the next 2-5 years, whatever it is, which impacts the price of swap rates, fixed rates, has essentially gone up. And so that's what's going on there. So a bit confusing for everybody, I know. It's very, very difficult because on one hand, I know we're seeing lots of talk in the press about base rate coming down, and therefore we naturally expect that fixed rates are going to come down. The two are not inextricably linked. Fixed rates are a prediction of what's going to happen with base rate, and actually the chances of base rate coming down as quickly as people have thought this year have diminished. Therefore, that pushes up fixed rate pricing. So getting that bit of good news out of the way, we're just going to have a quick look at lender pricing changes. Now, it has been a really short week, only 4 working days. I think a lot of lenders actually are probably looking at swap rates at the moment and thinking, let's not react instantly, let's just wait and see what's going on. So I suspect we will start to see more movement over the next week, depending on what happens with swap rates. So what we have done is see a couple of lenders brings pricing down, most notably the Skipton, who have reduced some of their rates, and TML have also dropped their 5-year fixed rates by 0.2%, so a pretty chunky reduction. So I think we just, to go into those lenders for a moment, I need to have a quick think about who they are and what's going on here. So the Skipton are a high street lender. They are looking at straightforward properties, lending to people with less than 10 buy-to-lets, all that kind of stuff. So these guys have dropped down some of their rates. TML, specialist lender, kind of part of the same group as Shawbrook. So these guys are looking at limited companies, HMOs, multi-units, day one remortgages, all those kinds of racy things. They do AVMs, it just goes on. So a really fantastic lender, TML, brought their rates down by 0.2%. Now, how have they been able to do this, bearing in mind what I'm saying on the other hand about swap rates increasing? So I think the first thing is to look at how they are funded. They are going to have exposure to the capital markets, but as I mentioned also, these guys have a connection to Shawbrook. Shawbrook are an institution who takes savers' money in, so they're not just reliant on the capital markets. They have a kind of blended funding model, so that's going to impact how exposed they are to the capital markets, therefore potentially giving them some room to bring rates down. Also, TML haven't repriced lately, is the other thing. So actually what they're doing is playing catch up to a lot of the rate reductions we've seen over the last couple of weeks. And this is why I say at the moment it's quite a confusing message for you guys, because on one hand I'm telling you swap rates have gone up, therefore lender pricing should increase. On the other hand, I'm giving you lenders dropping their rates, so I do understand. But as it stands at the moment, just to kind of really recap this point, and I can't reiterate this strongly enough, at the moment, swap rates have increased on 5-year money by 0.2%. Therefore, lenders' cost of funds will have increased, at least in part, by 0.2%. Therefore, some lenders are going to be forced to increase some of their rates. So if you are thinking about making an application, I would get in there really, really quick. Okay, now I just wanted to have a quick look at what's been going on with inflation. We know that inflation has a massive impact on mortgage pricing. So actually, I think it's really important that we kind of see what's going on here. So let's just have a quick look at the headline figures. So the CPI figure, where inflation was at 3.5%. Now, the consensus was 3.3%. The Bank of England were calling 3.4%. So a miss on the upside, and there was already a big jump up anyway, is never a good thing. And this is really what the markets have kind of reacted to. So month on month, it was 1.2% last April, it was 0.3% month on month, and CPIH in April 2024 was 0.5% month on month. So what's causing this? Well, there's a load of things contributing to inflation kind of spiking: housing, household services, transport, recreation, and culture. One of the only things that actually is doing quite well at keeping inflation down is clothing prices. Okay, now core CPIH is a better measure of the underlying situation, and this was up to 4.5%, and it was already at 4.2% in March, and CPIH annual services was up to 5.8%. So these numbers above 4, above 5 have been incredibly persistent. Now, core CPI, which is watched more closely, was up to 3.8% from 3.4%, so that's another big jump. CPI services were up 5.4%, having made some progress and got to just below 5% in the previous month. Now, we can look at all sorts of contributory factors here in terms of what's going on, but what are the key things driving this forward? So first of all, council tax went up by nearly 5% across the whole country, so that's going to have a massive impact. Also, water bills for the first time in a long time have increased. We had the national insurance hike as well, so that's also had a massive contribution. So there's lots of things kind of at play here, some big costs that households have seen increase. That's all going to factor into inflation. And like I say, the markets were expecting inflation to have increased, but not by the amount that it has done. Okay, now look, so the housing and household services have a 7% inflation rate for April 2025, and this is up from 5.1% in March. The blame here is all of the things we've just talked about, plus the price cap on other domestic energy, so electricity and gas. Changing the cap for July was announced this week, so the pain here is not going to be prolonged, but it is going to be a kind of spike for the time being. So actually we'll see that particular figure start to ease off again. So there you go, lots of things going on, but for those of you who are thinking, crikey, what on earth is going on with inflation, there's your answer, and I hope that goes some way to explain it. I do think this is a bit of a spike. I think things will start to slow down again. Like I say, the markets were expecting this to happen. This wasn't a great surprise. It's just that it came in at a much higher level than people were expecting. And that's really what's thrown the markets at the moment, causing swap rates to kind of inflate, among other things, because they're saying that actually because of the inflation numbers being different to what people were expecting, it's going to delay base rate coming down over the next 12 months or so. Okay, now the Mortgage Works have released one of their most wonderful reports. This time it's all about rental income. So I've done a bit of analysis on what's going there. And what they do is they dig into the average rental yield by region, which always makes really interesting reading. For those of you who are thinking about investing at the moment, this kind of information is absolutely gold dust actually. But I think for me, what was more intriguing is actually how higher the numbers are in the south of England, which is where we normally see the weaker yields. So I'm just going to go through the country, and I'm going to sort of go in a circle. I'm going to start from the northeast, and I'm going to work my way this way around for you, isn't it? Around the coast, coming up to the northwest. So northeast 6.9%, Yorkshire and the Humber 6.5%, East Midlands 7.1%. Then we start coming down. So east of England 5.8%, London Central 5.5%. That's really good. London outer 5.6%, the southeast more broadly 6.1%. So actually, that's what I'm saying. Actually, in the southeast of England, 6.1% as yield, I think is actually really respectable. Also, the numbers for London looking quite good. In my memory, if you said to me what's the average yield in central London, I'd be saying sort of 4.5. So that feels good to me. Keep going around the country now. So we're into the southwest, 6.1%, Wales 6.3%. West Midlands 6.3% and Northwest 6.8%. So obviously within regions you're going to get variations on this, and also the property type will impact things and all this kind of stuff. But fundamentally, if you're just looking for a region where you're likely to get the greatest yield, then the East Midlands is looking incredibly favourable, followed by the Northeast, and then we've got kind of the Northwest, the West Midlands and Wales all kind of sitting at the top of the tree. So pretty useful information there for property investors, and for those of you who have properties in those particular parts of the country, you can pat yourself back on the back if yield is your thing. Now, in terms of profitability, there was a bit of a survey with this report. 8 in 10 landlords are making a profit from their lettings activity. 8% are saying they break even, and 7% are saying they are making a loss. And this is for leveraged landlords, the landlords with mortgages. Unleveraged landlords, those who borrow, are less likely to make profit from their property portfolio than those who are unleveraged, which kind of feels common sense to me. I struggle to understand how you'd be making a profit out of a property if there was no mortgage on it, unless you were doing lots of renovation works, I suppose. Now, in terms of market dynamics, the proportion of landlords putting up rents has fallen 8% year on year to 70% at the start of 2025. So although the number has fallen, there's still 70% of you putting your rents up, so that's not a bad figure. Despite this, the incidence of rent increases remains relatively high, and at more than 3 times the level it was in 2020. So kind of just underlining what I've just said, actually, compared to 2020, 3 times more of you are increasing rents at the moment. So that's good news as well, because like I say, if rental yields are your thing, increasing rents is going to be really important to you. So there you go, some positive news to end. Not the most positive MFB news, I'm afraid. So hopefully we're going to be ending this week on a more positive note. Okay, so that's us for this week. Now, like I said, it's half term. Not a lot happens in the school holidays in the lending world when we've got things kind of going on in the background, like the swap rate situation, because lots of people are off. So I think actually what we're going to see is more movement sort of come into play next week. So like I said, if you are thinking about applying for a mortgage, do get your application and get your rate secured. You can always change it with a lender. I mean, 90% of lenders let you change the rate before completion. Most of them don't even charge you to do this. So genuinely, the best thing you can do is get an application in, secure a rate, and then you can just sit and watch what the lender's pricing doing. And at any point before completion, if the rates come down, happy days, move on to the lower rate. But if the pricing goes up, you can sit there and thank your lucky stars that you watched this video way back in May, and actually did that and secured the rate and got yourself a better rate than if you had just left things until June, July time, because you're waiting for base rate to come down, which is looking increasingly likely that it won't. There you go, lecture over. Have a fantastic week. And as always, if you need us, you can give us a call, 0345 345 6788, or have a little poke around on our website where you'll find loads of great information. See you again next time.